Hi friends, welcome to the NPTEL course Strategy and Technology, a practical primer. We are in week 5 with the theme of buyers, suppliers and competitors. In this lecture, the 25th in the series, we discuss the topic of competitor clusters and analysis. We discussed earlier two topics which are interrelated to each other: competitive moves and market signals. Everyone in the strategy department must be focused not only on the firm internally but also what happens in the marketplace in terms of all stakeholder movements. This lecture proposes an inside-out approach of organizations equipping themselves with adequate knowledge of industry shaping trends or inputs on competitive trends. We can say that competitive forces do not remain static. They vary in their intensity and volatility, depending upon how firms and strategic groups deploy their capabilities in competition. Focus on competitive clusters would guide us to the essential competencies that are enabling a superior competitive advantage for successful firms. It emanates in a way from the strategic group analysis, but not all strategic groups are the same as competitor clusters. So we need to really look at competitor analysis through the prism of competitor clusters as much as we look at from the prism of strategic groups. Michael Porter made lots of contributions to competitor analysis. First, a format for an in-depth analysis of competitors has been provided. It helps us gain better perspective of how a firm should formulate its competitive strategy. It also proposed a framework to move from random analysis of competition to a structured in-depth analysis. In fact, it provided an analytical framework which is based on sound theory. And also, it provided a framework to remove deficient signals and focus on meaningful signals. It was an advisory to not only collect information about competitors systematically and systemically, but also to act on informal tidbits of information. Porter has laid out a comprehensive list of 100 markers and metrics to identify competitor profiles. However, let's look at the issue in this. As long as the industry comprises a handful of players, be it 5 or 10, it becomes easy or even feasible to study in depth the competitor actions, competitor motives. Let's, however, look at an industry which has 20 players or 30 players. It becomes well-nigh impossible to study each of the competitor moves in the kind of extensive nature, in the kind of in-depth nature that is required of competitor analysis. We also have to study the overall strategic framework of the company before getting into the competitor analysis. That is, we should profile the competitor in terms of the vision, mission and goals, structure and strategy, capabilities and talent, and execution and results. This strategic analysis has to be done for the competitors. Generally, companies take 3 to 6 months of time to conduct strategy analysis for themselves. Imagine conducting similar strategy analysis for a whole lot of firms in the competitive market space. The entire resources that are available in the Department of Strategy or allied areas such as corporate finance would not be adequate to undertake this task. So we need a meaningful frame of reference to understand competitor strategy and also to understand market signaling and competitive moves. So there is therefore a need for an intermediate frame of reference which is very representative of the universe but also provides appropriate bandwidth for the firm to undertake the strategic analysis. So the analysis bridges or plugs the gaps that are there in Porter's framework of competitor analysis and also addresses the practical weaknesses of having 100 markers to be analyzed for 100 competitors, which is an impossible task. So we try to develop simplicity out of the complexity that is envisaged by Porter in terms of competitor analysis. The theory of competition is challenging because there is no single definition of competition or competitor. First of all, competitor definition is linked to the industry definition. Industry definition itself is a moving target these days because of the rapid changes in product profiles and market dynamics. The transportation business has moved into logistics business and has since moved into mobility business. players have become numerous. Now transport exchanges are being thought about. Mobility as a service is being thought about. Leasing of vehicles as opposed to owning of vehicles is being thought about. So the industry definition itself is undergoing significant change. Secondly, individual businesses are also changing in their profiles. Competitors could have individual businesses that completely look like the same from an external viewpoint, but internally they differ in terms of their product market combinations. The more a corporation becomes unitized and globalized, the greater will be the chance of multiple styles of competition from the same company. Therefore, the competitive profile of a single firm and that of a single business within a conglomerate could be completely different from each other. Even if a company is selling apparel and textile products as a single company, and a company within the conglomerate is undertaking the same business, the way the competitive strategy evolves between the two companies in comparison would be very different. Therefore, the impact of the industry, the impact of the individual business, and their overall profiling within the industry space need particular noting in developing competitor analysis. We also have to look at the current competitors as well as emerging competitors. When Porter proposed the competitor analysis, he didn't indicate whether the study must include all the competitors, a cross-section of them, or only the top 2 or 3. There could be two views on this, both with their own valid points. It might be sufficient if you address your competitor analysis only in respect of the top tier competitors, because they are the ones who represent the superior performance, and if you are able to exceed their performance, you would be in a position to be better than competition. On the other hand, even a trivial competitor could destroy an industry structure, as we have seen in the previous discourse, and those irrational actions must be nipped in the bud in order to stop the industry from deteriorating. And there could be opportunities to consolidate through acquisition of such trivial competitors as well. So a comprehensive and insightful competitor analysis could not only be complex but also be very resource intensive. So there are two approaches. One approach is outside in, that is, information flows from the outside of the company into the company, and those information pieces would be several thousands and several bits of information which may not make immediate sense unless they are put together in a particular manner. This approach is one of outside in. Published statistics, market signals, dealer-vendor moves, they all are taken in, internally assimilated analysis, and a view of competition would emerge. In the previous lectures, we discussed huge number of inputs for getting this kind of information. What I presented here just as 3 elements, published statistics, market signals, dealer-vendor moves, are reflective of those large numbers of inputs that are required. This might be achievable in duopolistic and reasonable oligopolistic industry structures. However, it would be impossibly people-intensive task when the number of players exceeds, let's say, 3 or 5. And it is a proprietary process in knowledge industries, and then it becomes even more difficult to analyze how competitors are engaging in those actions. Let us look at the inside-out approach as well. The inside-out approach says that large organizations and innovative firms would have adequate knowledge of industry shaping trends or inputs on competitive trends from employees who joined from those companies or from employees who constantly interact with the ecosystem. Also, there are capabilities within the firm to understand the megatrends, imagine the megatrends, and even shape the megatrends. So there are 3 factors of a company that provide a lot of information on competitor landscape. 1, from people who join from other competitors. 2, from people who continuously interact with the ecosystem. 3, from people within the company who are in a position to shape up the industrial ecosystem. So self-analysis is based on what employees say, what leaders say, and what associates say. Competitor analysis is one of internal analysis, consulting resources, and syndicated data. That is, to be able to do the analysis of competitors, you do it all by yourself. You also engage consulting resources and you also rely on syndicated data. For example, you want to analyze how different competitors are paying their talent pools. For that, you have to rely on syndicated data. On the other hand, if you want to undertake a competitor analysis of a company in global markets, you got to engage a BCG or McKinsey and Company to be able to understand what happens in that marketplace. And based on simpler data which is available openly from the public sources and gathered from investors and analysts, you can conduct your internal analysis. These are the three facets of competitor analysis which a company can do. There is therefore an inside-out approach which arises from self-analysis as well as competitor analysis. And that is a strategy component. It must be a regular analysis. It must be a continuously ongoing. When this happens, no specific goals and resources are allocated. Dedicated extensive external competitive intelligence in the inside-out approach. These happen automatically and on a continuous basis as they converge through process mechanics of the company as it operates within the industry. The issue, however, is that neither the outside-in nor the inside-out approach helps in establishing a robust and sustainable framework of competitor analysis that has a fair balance of resource deployment and information collection. That is, you can do inside-out approach, you can do outside-in approach, but how do you balance resources required for such approaches, and how do you manage the magnitude and challenge of information collection and analysis? So when you analyze each competitor, and let's say we have 30 of them on several dimensions, say 50 to 100 of them, each with multiple metrics, the emerging picture will be too diffuse to provide any meaningful conclusions. We know that even to analyze a company financially, we may have as many as 50 ratios by which we can analyze a company. There can be liquidity ratios, there can be debt ratios, there can be capital structure ratios, there can be return on various parameters ratios, then value-added ratios, asset utilization ratios. They themselves could be 50. Then we may have innovation angle. There again you have 5 to 10 parameters which are important. So given that, how do you ensure that you are able to manage the magnitude of the task within the resources that are available? Because the job of the company is to formulate the strategy and execute rather than only to analyze data. So we have to find out the convergent patterns of collective competitive behavior rather than divergent patterns of individual competitor behavior. So from the seemingly divergent profiles of individual companies, individual competitors, we have to develop convergent patterns of collective competitive behavior. As we discussed earlier, strategic groups are those firms which follow a similar strategy in each case along with strategic dimensions. That doesn't mean that the actual execution and the actual evolution of the companies is on that scale. And also strategic groups of strategy related to structural profiles and also related to the outcomes constitute a different kind of competitor cluster which is relevant for us. Therefore, the important dimensions that determine strategic groups will be low in number typically, whereas the competitors themselves would be very many in numbers. So how do we relate this? Strategic grouping gives us a very important lead towards analyzing the competitors. But competitor analysis cannot end with only strategic group analysis. We need to take it forward in terms of actions and outcomes in the marketplace and intentions which will be converted into actions in the marketplace. That is important. So we tested the relevance and appropriateness of strategic groups in the previous lectures. I myself had the occasion to test the appropriateness of strategic groups through my research at the Indian Institute of Technology, Madras, with the Indian automobile industry as the background. So the strategic strengths that are possessed by any good company are product innovation, manufacturing excellence, supply chain agility, market penetration, quality leadership, financial strength, just to quote 6. And these would be seen in terms of the competitive behaviors of the company: profitability, market share, market spread, distribution reach, price competitiveness, product launches. So 6 strategic strengths, 6 competitive behaviors. This itself will make 36 combinations. In addition, dimensions such as import dependence, export competitiveness, product diversity, R&D intensity, they emerge as useful criteria. Cutting across these parameters, so that we can develop more insightful strategic groups and predict their performance. But strategic groups do not indicate competitive behavior. Competitive behavior has an additional intensity in the execution of strategic groups because adoption of a particular strategy only indicates the competitive intent. It doesn't necessarily reflect competitive behavior or competitive outcome. Competitive forces vary in intensity and volatility depending upon how firms and strategic groups deploy their competitive capabilities. Strategic groups with an overlay of competitive behavior would provide a simpler and a more effective approach to analyze competition. This is where this lecture leads us to. That is, strategic groups plus competitive behavior is equal to competitor clusters. These strategic strengths and competitive behaviors can be related in a typical format, but they can also be represented in terms of specific measures. So taking forward from this analysis, we can say that competitor clusters are those companies in the strategic groups that have similar strategic dimensions but deploy their strategies with differentiated competencies and with different levels of competitive intensity. Indian power plant producers, that is capital goods producers for Indian power plants, are a strategic group. They are as innovative and cost efficient as the Chinese capital goods producers and suppliers. However, the latter are far more aggressive, that is, the Chinese capital goods producers are far more aggressive in leveraging their national systemic cost competitiveness to gain a lead over the Indian power plant producers. Clearly, when the Indian competitive strategy is being laid out by the Indian capital goods producers, they have to look at competitor firms from different strategic groups as well. A Chinese competitor group may follow the same strategic dimensions as a US strategic group, but the way the competitive intensity comes out from these two different national strategic groups is completely different. One company alone from US may be sharing certain capabilities of the Chinese strategic group and vice versa. So the competitor cluster cuts across these national strategic groups. That's what we are trying to look at in terms of defining and conceptualizing the concept of competitor cluster. Korean Samsung had both high-cost smartphone and low-cost basic phones. Sony had high-cost devices primarily. Indian devices, Micromax and Chinese device makers, particularly Chinese device makers when they started about 10 years ago, were low-cost devices. However, in no time, China created a new strategic group of low-cost, high-end smartphones and positioned them in a different and superior competitor cluster. As a result, Samsung had to redefine its response to define a new strategic group of new mid-range smartphones with certain high-end features. That's how the A series smartphones started coming up. So the paradox of competitor clusters is evident from the above two examples. Within a strategic group, the variation in competitive intensity defines the competitor clusters, and competitor clusters could tie together companies from different strategic groups depending on the way in which the competitive intensity is deployed by the companies. Let's look at this concept with a little more detail. When you look at the Indian automobile industry, we will get an additional example of competitor clustering. Indian automobile industry, as I mentioned, is a very fascinating array of companies with different capabilities and different strategic attributes. Tata Motors is a wholly multi-line indigenous company. Ashok Leyland is a wholly indigenous specialized company focusing on commercial vehicles. Maruti Suzuki, a largely indigenous specialized company focused on cars and SUVs. We also have different strategic groups of companies with different technologies. Here we talked earlier about the strategic attributes of three companies. But you can look at the technologies, the national origins of technologies, and have different strategic groups. Toyota, Maruti, Nissan, Honda and Isuzu belong to the Japanese technology. General Motors, Ford belong to the American technology. Hyundai and Kia, more recently, Korean technology. Mercedes-Benz, BMW, Audi, Volkswagen, Fiat and Renault, and more recently Citroën belong to the European technology. So you can have two types of strategic groups that are possible. But within each strategic group, we have strategic subgroups also of companies with high level of import dependence and or luxury orientation. While these companies could be grouped on the basis of technological and business strengths or business strategies as above, different competitor clusters would emerge when competitive behavior profiles are superimposed. A firm planning to enter the Indian automobile industry space therefore needs to be conscious of not only the strategic groups but also the competitor clusters that could emerge out of these strategic groups. Which national technology must be of relevance for this? Which product group is of relevance for us? And which kind of strategic dimension would be amenable to which type of competitive intensity? So that's the way you form the competitive clusters in the Indian automobile space. So what are the dimensions for competitor clustering? Not all these strategic dimensions are relevant for competitor clustering. Those strategic strengths which are reflected in terms of product innovation, manufacturing excellence, supply chain agility, market penetration, quality leadership, and financial strength are very important for competitor clustering. But this competitive strength is reflected in a certain competitive behavior. So what are the dimensions of the competitor behavior? Product launches, that is how many products you launch per unit time. Price competitiveness, how much higher or lower you are to the industry benchmark. What is the distribution range? Do you have 200 dealers or 2000 dealers? Do you have 1000 people service mechanic network or 10,000 people service mechanic network? So distribution range, the market spread, market share, and profitability. This is how the competitive behavior is reflected. So you have 6 strategic strengths and you have 6 competitive behavior profiles. A combination of strategic strengths and competitive behavior would help develop relevant competitor clusters. These 36 dimensions, again, need not be all the dimensions by which all the companies and clusters are analyzed. We may take up only those relevant combinations which are more positively or negatively correlated than others. That is important for dimensioning the companies in terms of clusters. So to be able to do that, we have to define 2 dimensions for clustering. The essence of competitive excellence of a company lies in the ability to simultaneously pursue strategies that are apparently contrarian but also equally result oriented. So these 2 dimensions are competitive intensity and competitive strength. Competitive intensity is the ability to consume significantly high levels of resources. For example, an unceasing introduction of successive generation of products, an unceasing establishment of capacity, and yet achieve outcomes that provide significantly high levels of financial strength. For example, high levels of product profitability. So competitive intensity is the ability from a strategic excellence point of view of establishing capacities, making investments, creating facilities, running products through the system, but yet achieve high levels of product profitability. That is an ability to manage with lean resources and yet achieve high scale and scope will lead to a position of market dominance and an intense competitor as a result. This is a balancing act between innovation intensity and investment intensity. What is the competitive strength? An ability to pack maximal innovation into minimal product count. For example, just 1 or 2 products per year, but each packed with breakthrough features. And that enabling maximal market spread and market share. For example, a global market footprint or over 50% market share. That is ability to do more with less. An ability to have the widest possible distribution capability with the lowest product pricing. For example, mass retailing of budget products, and still achieve high levels of financial strength. For example, corporate profitability. So, ability to pack contrarian attributes of a corporate strength in one index is the competitive strength. Many outstanding competitors of global industrial arena would be displaying these strategic characteristics, operating in different competitor clusters for different product lines. So competitive clustering can be carried out on 2 fundamental dimensions. One, innovation intensity and product profitability. It is a high-low 2x2 grid. In this approach, firms would be classified on appropriate scales in terms of these 2 factors of innovation intensity and product profitability. And this results in the outcomes in terms of what kind of competitors they are. The grids represent clusters that are high on both innovation and profitability, high on either innovation or profitability, and low on both innovation and profitability. And when you adopt this grid approach to competitor clusters, you will get a greater level of clarity as to how close and collectively how aligned companies are. This scaling technique is a very good scaling technique for understanding companies. So you can have 4 types of competitor clusters, which is a simple framework. When you have low innovation intensity, that is, you are not able to bring out products with improved characteristics, and when your product profitability is also low, the cluster of those competitors is operationally weak. So if you were to imagine that the good old Hindustan Motors, Premier Automobiles Limited and Standard Motors continue to operate in the automobile industry, they would display these characteristics and they would emerge as operationally weak competitors. On the other hand, you have high innovation intensity but low product profitability. An example would be Tata Motors. It is so innovative that it is bringing out so many models of cars. Even if it falls down, it is collecting itself and gathering more speed and coming up with better products. An example being the SUV resurgence that happened after the failures of Ariya and Hexa. A completely new line of products, Nexon, Harrier, came about. So this is the tactical superior competitor cluster, high innovation intensity, but because of the investments that have been made and the inability to pack investments in terms of higher profitability, the profitability has been low, but they are tactically superior competitors. On the other hand, you could have companies which are low on innovation intensity but high on product profitability. For example, Force Motors, that is previously Bajaj Tempo. Whenever you think of an ambulance, you will think of Bajaj Tempo. Whenever you think of a school bus, you think of Bajaj Tempo. Its innovation intensity has been low because the chassis, the frame, the monocoque construction, the engine power haven't changed over time. The number of products also haven't changed much over time. But the level of innovation has been so strong that it has endured the progress of time, efflux of time. And also it has economized in production and it has brought in lean production principles so that its profitability is high, brand recall is high. Therefore, that company is a tactically superior competitor. So all companies which follow this kind of approach get into that cluster. On the other hand, you have innovation intensity very high and product profitability very high. Example, in Indian situation, Maruti Suzuki, but true global benchmark is Toyota, which is able to come up with a whole lot of product innovations and also maintain a high level of product profitability. They are the strategically outstanding competitors. When we put companies in this methodology and when we put ourselves in this methodology in one of the clusters, we know how easy or how difficult it is to move from one cluster to another cluster. What should be our role model, what should be our goal, and how should we move across these grids or the cells. So competitive clustering on this methodology has already proved itself to be a great way of looking at competition and also the self with respect to the competition. Any strategic framework, be it the competitor clustering which I have described or any other thing which we may think of, must help us achieve successful entry into an existing or new industry or grow in an existing or new industry. So what is the strategic group which I must be present in? And what is the level of competitive intensity that I can deploy so that I know in which competitor cluster I would fall into? A new entrant to the white goods industry, depending upon the nature of product and marketing technologies, as well as market plans and financial resources, could be a full-line vertically integrated strategic group or a narrow-line outsourcing strategic group. Whichever way the grouping is done, the competition depends on the competitive intensity, competitive behavior that the company is bringing forward for that particular strategic group presence. Similarly, a new entrant to the chemical industry, whether to join in an industry-oriented chemical space, that is specialty chemical space comprising pharma, cosmetics, paints, etc., or join a strategic group where product line is agnostic to the industry. A new entrant to the Indian automobile industry, depending on the ownership strengths and resource allocations to the region, must decide whether it should be a part of import-dependent luxury car segment or a part of the indigenous component-based low and mid-range sedan strategy group. Companies such as Daimler-Benz or Mercedes-Benz, Citroën have chosen to be part of import-dependent luxury car strategy group. JLR also has decided to be in that group. But certain other companies such as Kia and Hyundai decided to be in the indigenous component-based low and mid-range sedan strategy group. So for perceptive entrants, entry into the industry or the business needs to consider the broader strategic group and the narrower competitor cluster within the strategic group. And as I said, the competitor cluster could also span 2 or more strategic groups. Choice of a strategic group provides definitely an appropriate strategic focus and scope to a new entrant, but that alone doesn't assure success. We have to analyze how competition would play out. Nissan sought differentiation through upgraded features, modern manufacturing, and niche marketing. On the other hand, Volkswagen chose import-dependent luxury car strategic group, but it positioned itself on a competitor cluster that offered a wide range of automobile products with higher levels of technology. Both the companies, however, could not match Maruti and Hyundai, which were in strategic groups of broad product portfolio and high scale, and the competitive cluster of lean operations and cost efficiency. Now you can see how positioning on a strategic group and positioning as a competitor cluster provides sustainable competitive advantage compared to those companies which are randomly positioned. For new entrants as well as established firms repositioning themselves, the choice of an appropriate strategy group is as important as the choice of competitor cluster in each case. Both have to be done simultaneously. So what is the guidance for the growth? Each firm in an industry, by virtue of evolution, falls into one or another strategic group. That is clear. But the company would have choices before it. It could move from one strategic group to another, or be present in the same strategic group, or be present simultaneously in multiple strategic groups. The choices for an existing company would be one of the 4 options below. 1. Remain in the base strategic group. That is, you have a strong specialized position and you build that in such a manner that it is entry deterrent for the others. Or you move to another more lucrative strategic group. That is, you seek a new strategic position for better viability or as a futuristic bet. If MG Hector moves to electric vehicles as a new strategic position, that could be a similar competitive move. Keep adding new strategic groups. That is, you specialize in wherever you are, but keep specializing in additional strategic groups as well. Typically a multi-horizon company balancing the present, emerging and future. Another way you can look at it is amalgamating all the strategic groups. That is, oligopolistic dominance in an industry along with dominance in each strategic group. Different companies can therefore have different strategic spectrums or niches. Strategic reconfiguration by firms could also lead to formation of new strategic groups with different characteristics. That is, if you start with this, but you find that strategic groups are amalgamated or new strategic groups are added, the strategic group formation itself undergoes a change, even as the industry restructures itself. So guidance for growth has to be, again, not static, but real time. Let us look at a few examples. Let us look at strategic reconfiguration in the Indian automobile industry. From the 1980s, the industry was evolving, and the path of evolution was based on the entry by overseas car majors. New strategic groups began developing, leading to structural reconfiguration. New competitor clusters also began developing. So in total, there were many companies in the Indian automobile industry, even in the 1980s. We had the small car. Maruti Suzuki was the leader there. Tech pioneer, segment creating, feature defining, global quality, fuel efficient and cost competitive, affordable. These were the characteristics of that competitor group, which was basically based on Maruti Suzuki. Daewoo was there, but eventually it went out. Otherwise, Maruti Suzuki and Daewoo constituted that segment. Then we had mid-sedan, the Hyundai kind of products. Segment extension, focus on middle class, upgrade from small car. Then there was the large sedan. Segment extension again, focus on esteem, Segment extension again, focus on esteem, business focus, feature rich, ultra premium pricing, Audi for example. Then SUV came in as a cross-country vehicle at first, but as a business vehicle later, and as a family vehicle as well. New segment, robust quality, a large family focus, business friendly, premium pricing. There we had Toyota Kirloskar motor. In large sedan we had Audi, Benz and other companies. Mid sedan Hyundai and other similar companies. So Maruti Suzuki entered first, followed by Ford, GM and Hyundai in quick order. Tata Motors was a differentiated indigenous major, straddling all the segments. Indica was there in the small car segment, and various other products were there in the other segments. Toyota Kirloskar, Renault, Nissan, Audi, Daimler-Benz, BMW, Skoda, Volkswagen, Kia and a few others entered at different points in different strategic groups and as parts of different competitor clusters. So, different groups and different strategies can be illustrated from this angle. For Indian automobile companies, movement from one strategic group to another has been a less favored option than adding one strategic group for itself after another. The following three illustrative examples are very clear on this. Let's take the example of Maruti Suzuki. From small car, added a new strategic group of mid car, added a new strategic group of SUV, and it became later a large car manufacturer like Ciaz. And together it became a full line manufacturer, Maruti Suzuki. Then Hyundai, it started with the mid-range. i20 in comparison with small is mid to small. So it started with a 1300cc car in terms of its entry position, then quickly added the small car which is i10 and i20, then went into larger cars and finally entered the Creta and other SUVs. It became a full line Hyundai. Toyota Kirloskar motor on the other hand started with SUV, went into a mid-size car, added a large car including imported versions, and now has a small car through cross badging with Maruti. Now it is Toyota. In totality, leading manufacturers such as Maruti, Hyundai, Tata or Toyota Kirloskar moved towards having multiple strategic groups and eventually being present in the total automobile canvas. However, the level of competitive intensity that is present in each of these strategic groups is different. So you can form a competitor cluster cutting across the strategic groups, and therefore it is a kind of facade by which companies compete based on strategic groups, but actually their ability to compete is quite different from the strategic dimension that is being seen. So the total competitor canvas you can redefine in terms of the competitor cluster, while the previous one defined in terms of the strategic groups, and that was fairly straightforward and simple and easily identifiable based on the product characteristics or in some cases market requirements. But in terms of understanding the competitor cluster, you need to deep dive into what the company is deploying in terms of its competitive abilities. So you have Maruti and Hyundai, high technology, low cost, low price competitor cluster. You have Tata Motors, indigenous technology, low cost, low price, probably even lower cost and lower price than Maruti and Hyundai. Then you have Ford, GM and Skoda, mid technology, not the best of technology, mid cost, mid price. We also have other companies like Toyota, Renault and Nissan, which are mid technology, high cost, high price. You can't say that Toyota Innova is the best in class compared to what the competitor could offer or what even Suzuki is offering in India. So there is a kind of mid technology syndrome there. Kia, premium technology, mid cost, high price. Audi, BMW, Benz, premium technology, high cost, premium price. So the competitor clusters are different from the strategic clusters which we have seen earlier. But in the Indian automobile industry, the growth and the continued dominance of Maruti Suzuki is attributable to the company recognizing appropriate competitor clusters and responding to them accordingly. Maruti recognized the strategic grouping of SUV and responded using its own competitor characteristics, and that's where it took a lead over Toyota Innova in terms of the numbers. Ertiga overshot Innova even after coming late into the market. So competencies and competitor cluster therefore become a match. Maruti became a highly successful entrant into the Indian automobile industry by creating its own small car strategic group. It also fought back new entrant competitor moves by successfully extending its presence to more strategic groups from small car to sedan car, utility vehicle and crossover. Thus, it created an unassailable competitor group. And why are we calling it competitor group? Because it also displayed certain characteristics of strategy, not dimensions of strategy, characteristics of competition, competitive behavior in real life, which enabled it to have competitive advantage. Wide product portfolio, top-end specifications, design and scale-driven cost economics, vendor and dealer ecosystem, parents technology support. And more recently, it is coming up with the CNG technology. As many cars as possible are being offered with CNG technology. In contrast to Maruti and even Hyundai, the modest growth of other car manufacturers with American and European technologies is attributable to their being focused on their strategic group membership rather than benchmarking themselves with competitor clusters. You may form a part of a virtuous strategic group, but unless you understand the appropriate competitor cluster, you will not be able to make the due impact with the strategic dimensions that you have chosen. That is the lesson which comes out of this analysis of strategic groups and competitor clusters. Competitor cluster is also an entry-deterrent mechanism. As we know, an existing firm has the advantage of incumbency, and not all strategies need to be developed and executed from a zero base. So there's a lot of advantage of being in the history of an industry, being the first mover in the industry or later mover, but with significant strength built up over the years. Therefore, the competencies and competitive actions themselves create an entry-deterrent barrier. It is of course open to the new entrants to break these barriers through appropriate competitive actions, but it is very difficult. Isuzu came in with its products, but it could not break into the entry barriers set up by Tata Motors or Kirloskar, that is Toyota Kirloskar, or Maruti Suzuki. Therefore, entry-deterrent competition is one of the important aspects of overall competitive strategy. We must exist to be competitive, and the competition is based on the strength and not because of irrational actions which we discussed were bad for an industry. This theorem has also a corollary, that is the disadvantage of the legacy of certain ineffective strategies that could have been pursued in the past. Just as good strategies help us in the right entry deterrence, bad strategies are going to welcome new entries. Overriding such advantages as well as disadvantages through the competitive cluster frameworks, firms can realize a unique potential to identify winning strategies, and that could lead to industry leadership. Therefore, instead of getting lost in a laundry list of over 100 competitor markers or understanding hundreds of ratios and indexes, a firm should simply focus on the essentials of competitive strategies of competitor clusters. So, identify the strategic groups, identify the competitor clusters, analyze the essential competitive strategies and choose which ones need to be respected, which one needs to be bettered at, and which one needs to be circumvented. Competitive clustering is more dynamic than strategic grouping and provides a more perceptive and more impactful dimensioning for firms to understand and respond to competitors' strategic behavior in an industry, and this helps a firm to optimize its potential regardless of the number of competitors and the levels of competition that arise in the industry. A range of 6 dimensions we talked about in the past, and we talked about 36 strategic dimension combinations that would be visible from that, and out of that we have also chosen a 2x2 matrix to illustrate the power of competitive cluster framework. But the important thing we need to do is that these competitor clusters are both a response as well as a result of the actions taken by the incumbent and new firms. Incumbent firms and new firms are always at loggerheads with each other. So rather than follow a unit level multi-factor competitor analysis, as I said, we have to look at a more efficient and more effective competitor cluster framework, which also works extremely well with a selective additional deployment of the framework of strategic groups. So this is a way of summarizing whatever we have discussed in the past several slides. Thank you.